Celsius has halted withdrawals in the midst of a bank run that threatens the wider crypto economy as well as maybe the world economy. What's that? Pass bow?
This presents the possibility of a liquidity crisis if too many lenders or borrowers default on their commitments. To put it in simpler terms, collateral rehypothecation was a large contributing factor to the financial crisis of 2008, and crypto lending platforms like Crypto.com, BlockFi, Celsius, and Nexo may be setting themselves up for a similar liquidity crisis.
Either way, this isn't financial advice. I'm just an idiot with a camera who said this last December.
If you haven't been paying attention or haven't been wanting to pay attention, then I'm here to tell you what's going on with Celsius and what you should do about it. TLDR version, things are bad, you should withdraw.
So listen to be at your own risk and like and subscribe if you want more bad advice. Before we jump into what's going on with Celsius, I think it's best to take a step back and take a look at ETH 2.0 and the merge. If you're already familiar with Lido.fi and ETH and staked ETH, then you can go ahead and skip this portion and get into the juicy stuff. But if you don't, then ETH 2.0 is the consensus mechanism upgrade that is currently slated for about 6 months from now in the Ethereum protocol. Right now, Ethereum runs on proof of work, but it's trying to move to proof of stake. And to incentivize adoption of that, this thing called the beacon chain, which is the start of that merging process and that transformation process. It's a smart contract that sits on Ethereum, and right now it has a bunch of Ethereum locked into it that will not become available until after the merge happens and people can start withdrawing from that staking contract. Enter Lido.fi, which is a decentralized staking pool that allows you to withdraw your ETH that's staked on the network in the form of STETH or staked ETH, which functions kind of like a derivative of the underlying collateral, which can't be accessed for about a year and a half. This staked ETH is earning yield based on the fact that it's being used in the staking process that Lido.fi has engineered, but you can use staked ETH to take margin positions in ETH, for example, or you can trade it for pure ETH on Curve Finance. And that's sort of where this story starts. There are basically 7 large holders of staked ETH, which you can see here, which has created a scenario that looks a lot like what was happening with Luna and UST. It's a little bit different, and we'll get into that later, but one of the other large holders of staked ETH is Celsius. And right now it looks like Celsius is experiencing a liquidity crisis. Right now, 72% of Celsius's Ethereum holdings are either locked in the staking contract itself or are in the form of staked ETH, which means they only have 27% liquid that can be used if people want to withdraw those funds. But the Celsius holdings are also a product of consistent mismanagement. You can see here that Celsius lost 35,000 ETH in the Stakehound hack, and then followed that up by losing $50 million worth of Bitcoin in the Badger DAO hack. There's also reports of Alex Mashinsky dumping the token through his wife's wallet. Even if that's not true, the Celsius token has taken a nosedive. And I know everything's sort of taken a nosedive, but it took a particularly bad one. 43% down today as of time of filming, and over 97% down over the year. Which means regardless of whether or not the company is insolvent, the people that were getting their rewards in CEL token are probably none too happy right now. So a bunch of people want their money out. Celsius might not have it, so they can't give it to people. But what caused this crisis? A lot of it probably has to do with Sam Bankman-Fried and Alameda Research, which Celsius sold a bunch of staked ETH to recently at a pretty big discount, and then Alameda Research turned around and dumped on the market, breaking the peg with ETH. So like I mentioned earlier, there's a pool on Curve Finance that is the staked ETH peg, and right now it is way over collateralized with staked ETH, making up about 75% of the pool, meaning that it's trading at about 95% of ETH value. This is causing people to lose confidence in it and causing a lot of sell pressure in staked ETH because again, staked ETH, although it is fully backed by ETH, it's not until about a year and a half from now. It's more like an ETH futures contract that is redeemable for the ETH locked in than ETH itself. So it's not quite like Terra, where Terra didn't actually have any reserves and they just printed the Luna token ad infinitum to try and prop up the price, but there was actually nothing sitting behind it. With staked ETH, there will be people who trust that the merge is going to happen and have a longer time horizon who will purchase this staked ETH at a discount. But if Celsius needs money, then they may have to sell off their staked ETH reserves, which could trigger a cascade of forced selling, because a lot of people who have staked ETH that they got from Lido Finance then used that to leverage their position, go long on ETH, and restake. And as the ratio of staked ETH to ETH keeps dropping, we may see even more margin liquidations. So the price may spiral down, but again, at the end of the day, it is fully backed, so there will be buying pressure of people who just want more ETH. But in the short term, it may force the price of ETH down. That may force the price of Bitcoin down. And then once we get to levels like 21,000 Bitcoin, we may see more forced selling from players like Michael Saylor. Luna and UST was a question of solvency. The money just wasn't there. This is not a question of solvency. This is a question of illiquidity. People need liquid capital or want liquid capital. Celsius has obligations to those investors, and if they can't pay them back, then it could cause a short-term price spiral. And that's not to say that that can't be concerning, because again, even though it's a liquidity crisis and not a solvency crisis, the 2008 banking crisis was a liquidity crisis, not a solvency crisis. Although maybe it was a solvency crisis in some cases. But ultimately, it was illiquidity that started that death spiral. Is that Bo from a year ago?
Also potentially concerning, Celsius lends out portions of the collateral borrowers hand over. This practice, known as rehypothecation, is similar to the way subprime loans were repackaged and sold as mortgage-backed securities and then resold as collateralized debt obligations in the years leading up to the 2008 financial crisis. All of this points to a potential systemic risk within the Celsius network that could be at the heart of this insane growth that people are seeing now.
The downward price movement that we've already seen has already resulted in $521 million worth of liquidations of margin positions. And this could just be the start. So where does Celsius go from here? So it may not be as bad as it seems. It's certainly possible that Celsius could just take on more debt to cover their short-term withdrawal requests, or they could offer a deal to ETH holders on the platform to exchange ETH for staked ETH, which would relieve a little bit of the pressure. I don't know though, it seems like the bank run is on and closing down withdrawals will probably only make it worse. But what does all this mean for you? Well, if you're on Celsius, sorry buddy. At this point I'd say try and get your money out if at all possible, but it may be rough. Hopefully you're not on Celsius. But if you're on another centralized lending platform or exchange, again, this could be the beginning of a contagion and you should get your money the fuck out of there. Buy a hardware wallet. It's the only thing I'm going to shill this video. Click the link in the description, go to the Trezor store, buy a Trezor, and take your money off the centralized exchanges. As I've been saying for a while now, you pay the price for their bad bets. Pay the price for your bad bets. And bet bad. But let's wait and see what happens with Celsius. There's two possible options, really. They could be forced to sell a large portion of their staked ETH holdings, which could cause a price spiral that drives the price into the ground, which honestly could be the best possible buy for someone who wants to stack ETH in the long term. From there, it's a conversion of ETH to staked ETH at a ratio that is actually pretty good. Of course, that means that you're going to have to wait until the merge is successful, and you have to hope that the merge is successful. But if you're willing to take that risk and you believe in ETH long term, then again, it may be a pretty good bet. I've also heard that this could be a narrative bear trap. That this idea that Celsius has a target on their back and that no one would be willing to give them a loan to recollateralize them is, fantasy. But I think that's a bit silly given that their problem is not just with illiquidity, but also their lack of transparency, their perpetual state of scandal, and their general mismanagement. We also have to pay attention to US equities markets because, as Nick Carter points out here, there's something wrong in the wider market. We're entering recession territory, we're entering depression territory, and so this may just be the canary in the coal mine telling us that shit fucked. So you may want to start thinking about your stablecoin allocation, especially if we see continued downward pressure on crypto prices in general, and you don't want to fully exit into fiat. I'm actually working on a big series on stablecoins right now, which should start releasing in the next few days. So remember, like and subscribe, hit the bell notification if you want to know which stablecoins you should and should not trust. I'll give you a little hint now. The TLDR is I love decentralized stablecoins like DAI and RAI, but this whole situation is going to be a huge stress test for these more experimental coins. So it may be safer to be in things like USDC and BUSD, which are heavily collateralized in US dollars and short-term T-bills. But if there's a larger financial contagion and the bank run continues, USDT may just be the next big peg to fall. We've already seen $10 billion pulled out of USDT and put into USDC over the course of the last month. So proceed with caution, like and subscribe, stay safe out there. F*** you, Alex Machensky.